Welcome to the Doctors Building Wealth podcast. Today, we're going to be talking about why so many accountants seem to miss real estate deductions. So, it's pretty common for Kenji and I to be out and around doing talks and to run into people who say, "Hey, I own a property. Maybe they're accidental landlords, and I've never really saved money from my real estate property on my taxes. Maybe they own a short term rental, medical office building, but they just haven't been able to get any tax savings. And they say that their CPA maybe didn't tell them."
So the question they ask us is, why didn't my CPA help me take advantage of these tax saving opportunities? And they wonder, like, are they incompetent? What's going on? And so we just wanted to kind of take some time to talk about why CPAs or accountants are missing these opportunities. And largely, just to kind of cut to the chase, it's not that they're incompetent. It's just that there's a long list of things or long list of possibilities or reasons why they might not be helping you save on taxes.
So, the first reason is lack of specialization. Real estate taxes really is like the neurosurgery of medicine. It's very, very highly specialized. And you should see when I go to interview people who are CPAs who want to get into our vendor referral network. The types of questions that I ask them is just kind of insane. They're very, very specific because understanding real estate taxes is just it gets down to the nitty gritty details. And so if you have a general CPA who really doesn't deal with real estate very often and they're just dealing with a broad array of issues, a broad array of businesses, they may not know these little tiny rules that are so important to you as a real estate investor to be able to access. And those are the things that are going to save you so much money.
Yeah, and it's not just the IRS tax code related to real estate, but you also have to be really familiar with the case law. And not only that, you also have to stay up with all the changes in the legislation. And so this is like if you're in medicine, like you have to keep up with the latest studies, right? So there might be a new drug study, and it might replace a whole class of drugs that you've been recommending to your patients for years, right? So these things may happen, and these do happen actually in tax law. The Trump tax law significantly changed the taxes around real estate, and so that's an example of how when that happened, you had to really kind of stay up on things. Even with Biden too, when he came into office, there were a number of changes that led to a lot of debates among the CPAs and even differences in interpretation.
Now, what this means in practice is we actually run into people who own a number of real estate properties and really could have gotten real estate professional status or own a short-term rental and didn't take advantage of the short-term rental tax loophole. And they have all these what they're called suspended passive losses. So they have all these losses that they could have used to shelter W-2 income if they were active real estate investors meeting criteria for real estate professional or using the short-term rental tax loophole. But instead, they have all these losses that are just sitting there that they can't access, they haven't been able to use. And it was literally because they just didn't know about these loopholes. And neither did their CPA even think to tell them about it, if they even knew about it.
Yeah, and there's a story I ran into somebody at a conference, and she was owned several short-term rentals. She was operating them herself. They didn't have a property manager, so she easily met criteria for material participation. And if you don't know what that means, be sure to go to our blog and check out the short-term rental tax benefit. It's an article where you can read about the short-term rental and how to get this tax benefit from short-term rentals. Anyway, she was meeting all the criteria for it, and she was not using it to shelter her husband's business income. And he was making over $1 million, and they had multiple short-term rentals, very expensive ones, and they could have actually sheltered all the income. And so what happened was when I met her, it was actually right around March. And so it was right before the tax deadline. And I told her about it. I connected her with one of our referral CPAs, and I just saw her recently, and she thanked me. She said, like, you saved me hundreds of thousands of dollars. Thank you. And so that was a great feeling. But again, just goes to show you that somebody in that situation who is meeting all the criteria, doing all the right things, but not getting the tax benefits.
And it also reminds me, once ran into somebody who, same situation, husband was a doctor, actually bringing in a fair amount of money. Wife had a whole long-term rental portfolio and had $1 million of suspended passive losses and could have easily met criteria for real estate professional based on all the work she was doing, but just had never been told about it. And so all these suspended passive losses had never been used to shelter W-2 income. Huge loss. This is how people lose lose hundreds of thousands of dollars, if not more, in tax savings. And it's all just because the CPA isn't familiar with real estate taxes specifically, or they're not up to date on all of the changes, and they're not on the active lookout for new real estate loopholes that they're able to help their CPA their clients with.
The next reason why your CPA might be missing all these opportunities is that they are overloaded and there's a lot of time constraints in accounting, right? And taxes because, there's a deadline, right? April 15th, October 15th, and they have so many clients, they have to get all these tax returns done. And because of that deadline, because they are so overloaded, there's really limited time to dig into each person's specific situation, understand it, look for these opportunities. A lot of these things that you implement, you really need to implement ahead of time. You can't just all of a sudden take advantage of them. And so, if you're trying to implement these things right around tax time, good luck. The chances are they're not even going to pick up on these things.
Yeah, I have to say I felt very badly for CPAs because they have such a terrible crunch time around taxes. The stress level that they have, the level of amount of hours that they work during that time, it's just I think it's a very tough job, and I have to give them a lot of credit for everything that they do because the stress level is insane during that time. And so I agree with Kenji. You've got to get your CPA way earlier in the year, far before tax time, and then you've got to be on top of it. You got to be maintaining your conversations with them, sending the information, be organized yourself, be able to provide them with all the receipts. And Kenji even gives them a list of all the rehabs and talks about which are repairs and which are improvements. And so he does a lot of that upfront thinking, and he does it ahead of time before tax crunch season, so that the CPAs really are able to walk in, have a pretty complete file put all together by Kenji. So he's doing a lot of the work for them, but then they're able to go next level, make sure that everything's correct, see other things that maybe he missed, and have adequate time to do that type of thinking instead of being in the weeds of trying to figure out where is this receipt and what is this.
Yeah, I'm taking real ownership of the process. And so I'm not abdicating responsibility. I'm educating myself about the tax law and the opportunities and how to maximize those opportunities. And then I'm actually organizing all my paperwork in a way that when I present it, it's very clear. It makes it very easy for them. Again, I'm thinking about how busy they are around tax time. If it's a mess and I hand them a mess, they're going to be very frustrated, and it's probably going to they may even say, "Hey, we may not be able to take advantage of this year because there's not enough time to take advantage of it." So that's what I try to do.
And not only that, the amount that saves us in money and charges, because our CPA bills by the hour, is astronomical. We know because we have other people who go to the same CPA who paid a lot more in taxes because they were not organized and they were not being proactive and they weren't doing a lot of the thinking up front like Kenji does for our CPA. And that, as a result, cost them a ton of money of extra hours at tax time. And again, it's not that high level thinking of being able to look at a picture and really go deep into their analysis. It's really that low level, like, I don't have this receipt. Where's this data that they're spending their time on with their client? And it's just not the highest and best use of your CPA.
This next one we've alluded to already, and that is that strategy is completely different than tax prep. And so a lot of people think they're paying for just the tax preparation and getting that file, taxes filed. But really what you need to think about this is strategy is a completely different bucket. And oftentimes CPAs are charging completely separately for strategy. And that's something that you probably want to meet with your CPA maybe 4 times a year to make sure that they are apprised of all the things that happened in the previous quarter, right? So if there was a sale, for example, you're going to want to make sure that you talk to them about it, you give them the paperwork. Also, if you're planning to sell something, right, there may be an opportunity for something called a 1031 exchange. And so you need to actually involve them before you sell the property, before you get the money, because once that money hits your bank account, you can no longer 1031. So again, strategy is very different than tax prep, and you need to get way, way ahead of the actual tax deadline in order to implement these things. And there are some of these things require actual studies. There's something called a cost segregation study, which you need to do well before you file your taxes.
And we often run into people who say, well, why are these real estate CPs so expensive? Maybe they're used to spending, $1,000 or $1,500 on getting their taxes prepared. And all of a sudden they're staring at a six, seven, eight, nine, 10. And for us, it's actually multiple five figures of a tax bill every single year and wondering, like, why would I even pay this? It's because of the strategy. It's because of the deeper level thinking. A really phenomenal CPA should be saving you money because they're thinking and finding so many other write-offs that you wouldn't think about that they actually are going to pay for themselves. And so I know it's a lot more expensive, and it can be shocking for somebody who's a newer real estate investor and who's all of a sudden going from using TurboTax to now paying an individual that's charging them $8,000. But a really great CPA, if you have several properties, I definitely would be using a CPA. And ultimately you're also guarding against the fact that you don't want to get audited and be by yourself having just used TurboTax, because real estate taxes are a lot more complicated and you just don't want to be doing it yourself. I would not never advocate for doing your own taxes if you own real estate investments.
And that leads really nicely to the next reason why your CPA is probably missing these real estate deductions is the complexity of these real estate transactions. There are just so many details that it's really easy to miss important deductions. And I'm going to just list a few deductions that you may want to mention to your CPA. They may be missing these things. I don't know if they are, but if you mention something like de minimis safe harbor, right? Are we taking advantage of that? Partial asset disposition, categorizing expenses as repairs instead of capitalizing them. Your CPA, if they are real estate trained, they're going to know what this means. You may not know what it means, but just saying these things and saying, hey, are there opportunities with these things that I'm mentioning, these phrases, that may actually result in some savings here. But it just goes to show you how complex this area is. And again, it is very easy for them to miss these things because implementing the things that I just talked about, some of that requires what we were just talking about earlier, where I actually do a lot of the work. Like, so for example, categorizing repairs versus depreciation, right? Something that's depreciated over time. That is something that I put into a spreadsheet and I make it very easy. I spoon feed the CPA the information so it makes it very easy for them to make something a repair instead of a capitalized expense or depreciated expense.
The final one is risk aversion. The fact is that we've run across a lot of accountants over the years who just have such a fear of audit that they don't pursue what they think are aggressive deductions, which may be totally reasonable deductions to other CPAs, especially those with real estate experience.
Yeah, something like real estate professional status, the criteria are actually very, very clear. And so it's not gray at all to a lot of real estate CPAs. But again, there are a whole bunch of CPAs out there who look at something like that and just immediately revert to the idea that it's going to increase your chances of audit. So it's not even worth it. Don't do it. Right. And that's kind of their stance. And then they're going to really discourage you from even doing it.
And the sad thing is, a lot of times they don't see the potential upside and they're not weighing that at all. It's like having a lawyer who very much is always thinking about the downside and doesn't look at the potential upside and doesn't give you a balanced view of what you should do and what are the percentages that you're actually going to benefit from something versus the potential downsides. It's just all focused on the downsides. And so I think it's really important to know your own level of expertise in this, to go in and be able to help create strategy, to understand the basic tax law, so that if you just get into a situation that you have a very risk averse accountant, that you'll recognize it and you'll have a little bit of knowledge to be able to say, this doesn't make sense to me. I meet these criteria, that here are the hours. Why, tell me again why I shouldn't be doing this. I can see that I'm going to save hundreds of thousands of dollars in taxes. Like, can you explain yourself? And if it's not a fit, if you see that they maybe don't have enough real estate knowledge, or they're just on that side that they're so conservative they would never consider doing that, even though you meet criteria, that might be a time where you want to move on from your CPA, go find a really great real estate focused CPA, and one who wants to be your partner in helping you maximize your tax savings in a very legal way, but getting you what you deserve instead of just staying on the conservative side and just always saying no. So this is a question we get a lot then out of all of this is, I find I have a CPA, they don't know a whole lot about real estate, maybe they're very, very conservative. What should I be doing in this situation? Well, what we found, just like when we first started out and we had a residential real estate agent who we were trying to train to be an investor friendly real estate agent, is it takes a lot of energy, it takes a lot of effort. And really, you're paying your CPA to see strategies and help be your partner in making you more money and saving you more money. And so if you're spending all your time educating them, the odds are very low that they're going to be able to actually go out next level and save you money. And not only that, it's a lot of energy drain that you as an investor should be spending finding more deals. And so ultimately, we have always chosen to work with CPAs who are very knowledgeable in real estate investing, ideally real estate investors themselves even, and who are, reasonable. They look at the law, they can give me a balanced perspective on whether or not we want to do something, and they understand all the rules and regulations and can help be a strategist for us so that we can maximize our tax savings in a completely legal way.
Yeah. So if you find yourself in this situation where your CPA doesn't know a lot about real estate, we talked about, okay, maybe you can go out and find a real estate CPA. But I think the other really important thing here for you to do is to educate yourself and become your own advocate. And so, in other words, learn about the tax law. You don't have to get into the absolute nitty gritty, but enough so you can bring uh, the questions to your CPA, right? We talked about some of those terms. It'd be good to learn some of those terms that maybe you don't know right now, but learn a little enough about it so that you can ask the right questions during a strategy session with your CPA for discussion. And this is something that we learned from a friend. He called it the strong bias and validation approach to working with experts. And that is develop that strong bias before you go in to speak with them, and then really use that time to have them validate the bias that you've created. And so that's the idea, is that you come in with a perspective and have them validate it or tell you that no, you should really approach it this way. And we found that to be a really effective way to work with these experts.
Now, where you can develop the knowledge to be able to be this tax strategy partner for your CPA, definitely go to our blog, semiretiredmd.com. We've got so much tax strategy and blog articles we've written about different tax loopholes that we've accessed ourselves or members of our community have. So go start there. Another great place to go is Amanda Hahn and Matthew McFarland have a phenomenal two-set book series on for real estate investors, and it's called Tax Strategies for the Savvy Real Estate Investor and Advanced Tax Strategies. And those are really excellent books that will give you a framework and a lot of knowledge to be able to approach your CPA in a really knowledgeable way and be a strategy partner instead of somebody who's just hearing what the CPA says and not having any context and just blindly walking along doing things that may cost you hundreds of thousands of dollars in taxes, and because they're missing things like we talked about at the beginning of this episode.
And of course, this podcast also has a number of episodes where we talk about these different tax strategies. So be sure to go back and listen to those episodes.
Yeah, we have Amanda Hahn, we have Tom Wheelwright, we have a ton of really great CPAs who we've interviewed. So definitely make sure you check those out as well. Well, thank you so much for joining us on the Doctors Building Wealth podcast. Remember to leave us a review. And if you have any comments about today, feel free to reach out to us at support@semiretiredmd. We'll see you next time.